Welcome to today's episode. I'm thrilled to have you join us as we dive into some pressing financial news that could impact both individual investors and the economy at large. Today, we'll explore the alarming rise in foreclosures, the IRS's new 401k contribution limits, and the evolving landscape of AI investments. There's a lot to unpack, so let's get started. Joining me today is our expert guest who has been keeping a keen eye on these developments. Welcome.
Thank you. It's great to be here and discuss these critical topics. There's certainly a lot happening in the financial world right now.
Absolutely. Let's kick things off with the surge in foreclosures. It seems like every time we turn around, there's another report indicating that foreclosures are on the rise. What's driving this trend, and what implications does it have for the housing market?
That's a great question. The rise in foreclosures can be attributed to a variety of factors. One of the primary reasons is the end of pandemic-related moratoriums that temporarily halted foreclosures. Many homeowners who were already struggling to pay their mortgages have now found themselves in a precarious position as these protections have lifted.
Right. It's almost like a delayed reaction, isn't it? The economic fallout from the pandemic is still being felt.
Exactly. Additionally, rising interest rates are making it more difficult for homeowners to refinance or sell their properties. This is especially true for those who bought homes in the last few years when interest rates were low. Now, with rates climbing, many homeowners are stuck with higher monthly payments and less equity.
That's a tough situation. So what does this mean for potential home buyers and investors in the housing market?
For home buyers, this could present both challenges and opportunities. On one hand, the increase in foreclosures might lead to more properties becoming available at lower prices, which could attract investors looking to purchase distressed assets. However, it also signals a potential downturn in the housing market, which could affect home values in the long term.
And for investors, they must be watching this trend closely.
Absolutely. Investors often thrive during market corrections or when there's an influx of distressed properties. However, they also need to be cautious. Investing in foreclosures can come with its own set of challenges, such as potential repairs or legal issues that may arise during the purchasing process.
It sounds like due diligence is more critical than ever. Moving on, let's discuss the recent IRS announcement regarding 401k contribution limits. This news has significant implications for retirement savings, doesn't it?
Yes, it does. The IRS has announced an increase in the contribution limits for 401k plans, which is a positive step for many workers looking to bolster their retirement savings. For 2024, the limit for employee contributions is set to increase, allowing individuals to save more tax-deferred money.
That's encouraging. How much of an increase are we talking about, and who will this benefit the most?
The increase varies, but it's substantial enough to make a difference. For instance, the limit for employee contributions will rise to $23,000, up from $22,500. This change particularly benefits individuals who may be behind on their retirement savings or those who want to maximize their contributions as they approach retirement age.
It seems like a strategic move, especially considering how many people are worried about having enough saved for retirement.
Exactly. It addresses the increasing cost of living and the need for a more robust retirement fund. Additionally, there are catch-up contributions for those over 50, which further incentivizes older workers to save more as they near retirement.
It's crucial to encourage people to take advantage of these limits. What advice would you give to listeners regarding their retirement savings strategies in light of this news?
I would advise listeners to evaluate their current savings and consider increasing their contributions if possible. It's also wise to take advantage of employer matches if available, as that's essentially free money. Furthermore, individuals should regularly review their investment allocations to ensure they align with their long-term goals.
Wise words. Now let's pivot to our third topic, AI investments. The narrative surrounding AI has shifted quite dramatically over the last year. What are some of the key developments you've noticed?
The excitement around AI technologies has led to a boom in investments, but we're also starting to see a more cautious approach from investors. Initially, there was a rush to fund AI startups with lofty valuations. However, as the market matures, investors are becoming more discerning about which companies have sustainable business models.
It's interesting to see how quickly the dynamics can change in tech investing. What specific factors are influencing this shift?
One significant factor is the overall market sentiment. After a wave of enthusiasm, some investors are now considering the potential risks associated with AI, such as regulatory challenges and ethical concerns. Additionally, there's increasing competition in the space, which can make it harder for individual companies to maintain a competitive edge.
Right? That makes sense. So how should investors navigate this evolving landscape?
Investors should focus on companies that demonstrate a clear path to profitability and have a solid understanding of the ethical implications of their technologies. It's also essential to diversify investments to mitigate risks. Instead of placing all bets on one AI startup, spreading investments across a range of companies and sectors that utilize AI can help balance the portfolio.
Great advice. It sounds like due diligence and critical thinking are paramount in this rapidly changing environment.
Absolutely. Understanding the fundamentals of a business and its long-term viability is key, especially in a space as dynamic as AI. Investors should also keep an eye on emerging trends that could impact the market, such as regulatory shifts or technological advancements.
It's fascinating how interconnected these topics are. Foreclosures, retirement savings, and AI investments. They all reflect the broader trends in our economy.
Definitely. Each of these areas has implications for individual financial well-being and the overall health of the economy. As we see the housing market shift with rising foreclosures and the importance of retirement savings becoming clearer, it's crucial for investors to stay informed and adaptable.
Well said. As we wrap up today's discussion, what final thoughts do you have for our listeners about these financial trends?
I would encourage everyone to stay proactive about their financial planning. Whether it's navigating the challenges of the housing market, maximizing retirement savings, or evaluating investment opportunities in AI, being informed and prepared is vital. It's an ever-changing landscape, and those who take the time to understand it will be in a better position to thrive.
Wise advice. Thank you for joining me today and sharing your insights on these important topics.
Thank you for having me. It's always a pleasure to discuss financial trends with you.
And thank you to our listeners for tuning in. We hope you found today's conversation informative and engaging. Remember to stay informed, and we'll catch you in our next episode where we'll dive into more financial news and insights. Until next time.
Goodbye, everyone.
Bye.